Hey guys. So today I'm not going to answer any questions today because I want to talk to you about something that I think it's pretty much on everybody's mind. It's the elephant in the room in the crypto market, which is the 4-year cycle or whatever, the crypto market cyclical position plus the macro environment that we are in. Okay? Because this is obviously very important to everybody's portfolio, and actually I have been writing about this. I had an article out last week, a week ago. If you check on my website, it should be there's the most recent article, and the second one should be the one about the macro environment, the macro outlook for this year. But this is something that I've been thinking about a lot recently, right? And my conclusion is, right now, this is the current thinking. And there are several pieces to my current thinking because we are in a sort of a complicated environment. And I hope you'll see why in a minute once we get into it. So my goal here is to present to you what I'm thinking about, how I'm thinking about this environment. It's not black and white. It's not clear cut. Okay. So you take all this information, and you can see like what is appropriate for you, right? But first of all, I want to tell you is like I've said many times before. Long term, I'm very, very bullish about the crypto market because to me, it's not just a technology revolution, but it's actually an economic revolution enabled by technology. It's a revolution in how we distribute economic gains in society. And that is solving probably, one of the biggest problems of our time right now, aside from climate change, which is the income distribution. It's one of the biggest problems I think is facing humanity today. So that's why, and crypto is providing an answer to that. At least it's on its way to providing an answer to that. So that's why the fundamental high-level reason why I'm bullish about crypto. Okay. That being said, we have these cyclical conditions, right? So I told you before, this is a market. I'm not going to try to take profits and leave forever. I will try to hang around this market because my long-term thesis is very bullish. But if you look at the short-term environment, okay, here are the several aspects to this. Number one is the monetary policy from the United States. And this is like the biggest parameter of any risk asset market in the U.S., around the world, right? And it's pretty much a certainty that the Fed is going to tighten this year. Now, I know some people are telling you, or you probably have heard from other people that the Fed cannot do much because they have to prop up the asset market because otherwise everybody suffers. Because everybody is so leveraged, the debt level is very high, right? And all that is true. However, that doesn't mean they're not going to do anything in the short term because we have higher inflation, right? And also the other thing is the higher inflation is I would say 60% of it is supply side, meaning it's a supply bottlenecks caused by COVID, caused by people stop working, logistic hubs not working. You have all these supply chain congestions and broken broken stops in the global supply chain. So that is, I would say, 60%. Or maybe 65% of why we are having a higher inflation numbers right now. But aside from that, we are also, at least in the United States, other countries is different, right? But other countries are also affected by the United States. In the U.S., we are in a also in a pretty heated demand condition right now. So economy is not doing bad at all. Unemployment is, I think it's 3.9, 3.8%, something like that. So it's really close to full employment. And if you look at, retail, service sector, obviously down given COVID, but really it's not been doing bad. So you may say, oh, how can you say the economy is not bad? You look at, zombie firms and everybody have so much debt and cannot pay, right? Income inequality, so on and so forth. Those are all true, okay? But let's not confuse the long-term fundamental with the short-term cyclical condition. So the cyclical condition, we are on we are definitely not in the trough. We are on the way to the business cycle top. So it's on the not the business cycle top, but on the ascension, right? So to the boom, over the boom period. So that means, as any central bank, this is definitely it is just the right condition for any central bank to tighten monetary policy right now, and no question about it. Okay, how long that tightening is going to last, how fast, how severe, that is a totally different question. But I think we should establish that, from the get-go, you're going to see monetary tightening, no doubt about it. Okay, starting in March, and actually it's already started, because the Fed it's already said that they're slowing the pace of asset purchases, which is the so-called quantitative easing, starting in November. So that is the macro condition we're in, and that is going to affect risk assets. Now, back in the days when crypto market was very small, it was relatively uncorrelated with the TradFi risk assets like, stocks and bonds and real estate, so on and so forth. Nowadays, it's no longer the case. I think the bigger market cap tokens like, Bitcoin and Ethereum, they pretty much move alongside the TradFi traditional risk assets like U.S. stocks. We talked about before that there is a correlation. There is a cyclical correlation, but there may not be a trend correlation, because the trend for crypto is different from the TradFi stocks, because crypto assets is on the exponential growth path. So the trend is diverging, but the cyclical element is the correlation is actually getting more. It's getting tighter, because you have the same batch of investors in crypto now as in traditional stocks and bonds, because you have a lot of institutional investors, hedge funds, and so on and so forth. So you have larger retails getting into crypto. So whatever conditions that affect risk assets is going to affect crypto. At least the large caps. Those will be the most obvious, correlations. So here so here's the thing. What I want to tell you is I think the macro condition has already been affecting crypto market actually in the past few months. So if you look at the crypto market cap right now, we are like somewhat over $2 trillion, right? Starting the year, it was 800, and now in over the course of the year, it go up to almost 3 trillion, and now we are at sort of over 2 trillion. So if you look at this last 6 months, it's the market is crypto market cap, total crypto market cap is pretty flat actually. There's a some significant volatility, but it's not growing. So what does this tell you? That tells you there is basically limited new money flowing into crypto from the rest of investor base. Because we still have about 60% of the crypto market cap is BTC and ETH, right? So new investor coming into the market, the first thing, what do? You buy BTC and ETH. So those are really the two major assets that new money flowing into crypto buy, right? So I think to a large extent, the price appreciation of those biggest market cap assets in crypto are being supported by new money flowing into crypto market. However, at the beginning of 2021, we had, again, an $800 billion asset class. It grew over 200% over the year, right? So this baby is getting bigger. It needs more food proportionally to keep growing. So you may think that, yes, there are always money coming into crypto. And you've seen, you always hear in the news, oh, so-and-so, famous investor or institutions getting into buying Bitcoin, buying Ether, getting into crypto, setting up funds, so on and so forth. Those are all true, but if you actually look at data, you will realize there is actually no acceleration of funding into crypto market. Otherwise, you will see large cap pumping. So, I think there are multiple reasons for this, okay? But I think one of the reasons is we are not seeing a acceleration of quantitative easing from the central bank, from the U.S. central bank in the past few months, unlike in 2020 or early part of 2021, you still had an acceleration of asset purchases from the Federal Reserve. So that, to a large extent, is pumping extra liquidity into the market that flows into all risk assets, right? So that driver is getting diminished. It's not gone, but it's getting weaker and weaker. So I think that is one of the reasons why we're not seeing acceleration of new funding flowing into crypto the past few months. And without acceleration of new funding, while this baby has grown, right? You need more food, but there's no like a higher quantity of food coming in. If it's the same quantity of food as before, you are not going to see significant price action from the major, from the larger caps, crypto assets. So basically that's number one. All right. So if you look at what's happening in the past few months. Now the question is, going forward, are we going to see acceleration of new money coming into crypto? Again, over the long term, no question about it, I think there will be more and more money coming into crypto. But in terms of, just talking about next 6 months, next year, what are we going to see? And my current thinking is I just cannot find any strong reason why we would see a acceleration. If anything, it's a deceleration. Why? Because the macro environment, again, is getting worse. And as we talk about, the QE from the Fed is a major driver of risk asset appreciation, right? So QE right now, asset purchases is still going on, so you're still seeing Fed balance sheet expanding, okay? But keep in mind, they already said starting November, they are going to start decelerating. So, but you're still seeing, balance sheet expanding, but starting in this quarter, I strongly expect it to slow down, if not completely flat. If you can go Google it, Fed balance sheet, look at the chart, very straightforward. Okay, it's been going up. It had a huge, very steep up since March 2020 for a couple months, very, very steep. And then it kind of, the angle tapered, but it's still on the trend up. And it's a pretty steep up trend. But starting this quarter, I expect to see deceleration, if not complete flat, of a balance sheet expansion from the Fed. So, and also, obviously, the Fed is also going to raise rates, right? So they've already said this year and next year, expect 3 to 4 rate increases. Now, if you look at the past, what happens when quantitative easing started tapering and interest rate tightening, interest rate raising starts? What happens with asset market? I think you will notice that QE, or the diminishing of QE, has a much bigger impact on risk assets compared to interest rate and compared to raising interest rate. Because, QE, or the opposite of it, quantitative tightening, which means shrinking of Fed balance sheet, is taking liquidity out of the system. So it's a more direct impact compared to the interest rate channel. So it's like interest rate is like coffee, quantitative easing is like heroin to the market. It's a different level of stimulus and different level of addiction. So if you look at what happens, the last so-called taper tantrum, which happened in 2013. Actually, it didn't happen in 2013 because it happened in 2014. In 2013, Bernanke said, we are going to stop asset purchases and we are going to taper. That's what he said. But they didn't start actually doing that until like late 2014. Okay. So what you see is, so if you look at Fed balance sheet, it continue when Fed announced they're going to taper in 2013, but their balance sheet continue expanding until like October, maybe like October, November of 2014. Then it started going flat, and then in 2018 it started going down. So it started going flat in late 2014. It roughly stayed there a little bit down for like 2 years. Okay, because we have 15, 16, 17, actually almost 3 years. And then in 18, it started going down. That was like a serious tapering starts. Okay, so you hold that picture in your mind for a sec. Okay, and then I'm going to tell you what did stock market do. 2013, when if we look at the SPX, S&P 500. 2013, when Fed says they're going to start tapering, but they actually didn't start. Okay, 2013 you had a bull market, S&P up. Okay, 2014 you still mostly had a bull market because keep in mind I just told you, the tapering didn't really start. So balance sheet expansion didn't stop until late 2014. And late 2014 is when the market start going sideways. S&P 500 started going sideways, and 2015 you had a market down because that is the first year when this balance sheet, the direction of balance sheet started to reverse. Before it was up, starting 2015 it was flat. Okay, so it was a year where market has to adjust to this, kind of, the stopping of liquidity expansion. And then, 2016 and 2017, the balance sheet didn't do much. The Fed balance sheet didn't do a whole lot. It was flat. So you had 2 years of market expansion because, market, it takes a while to adjust, and then market adjusted. And then 2018, you had a down year when Fed seriously started tapering. Like a balance sheet started shrinking, not just flat. Okay, so And then obviously after that, what happened? 2019 in late 2019. So the shrinking of balance sheet continued in 2018, 2019. In late 2019, it started expanding again. Why? Because U.S. economy started showing weakness. That was one of the reasons. That was even before the pandemic. U.S. economy was entering recession, right? So that was when stock market started seriously going up in 2019. And then we had March 2020, obviously the COVID shock, and everything went down a whole lot in the short term. And then Fed came into the rescue, pumped out the liquidity a order of magnitude more, and then market going berserk, crazy. Stock market, crypto market, real estate market, whatever market you can think of. So all this very detailed and boring recount of the relationship between Fed balance sheet and stock market is what my point is. What I'm trying to show you is this has a serious impact on risk asset, okay, the direction of Fed balance sheet. So really right now we are just hearing news. Jay Powell said we're going to tighten. Yes, they are, but they're going to start with first deceleration of asset purchases before a complete stop, right? So deceleration first, and then a stop, and then maybe at some point contraction of balance sheet. So it's not going to just happen overnight, right? Otherwise, they're going to kill the economy, and they're not going to do that. They're going to try to tighten some, right? Because they definitely need to do something, because we are in a cyclical uptrend, and we are in a high inflation environment. There is no excuse, no justification for the Fed not to tighten. But they're going to raise rate, and then they're going to slow down the asset purchases and see what happens. But my expectation, my guess will be, we are going, as they are doing that, we're going to see more volatility in the market, but we are not going to see like a market crash. Okay. Well, volatility in crypto is like pretty huge, so sometimes you can call it a mini crash, right? So, but we are going to see more heightened volatility, as in fact you have been seeing it since December. So because the market is on edge, everybody is skittish, everybody is like looking out for what the Fed is going to do next. Everybody's nervous. So any sign of policy direction change, you're going to see more volatility reflected in the market, and that's what we've been seeing. But seriously, I don't expect it to seriously affect asset valuation until the balance sheet start going flat. So remember, we previously talked about between when the turning point from it going up, balance sheet going up and turning flat, that turning point is a major adjustment for the asset market. So it's like took the stock market a year to adjust to that. And then after that, the turning point from balance sheet flat to balance sheet contraction, that was another major adjustment, and it's a much bigger adjustment for the asset market. So my point is, at that point, until we see the balance sheet going flat, it's not a like life or death threat to the asset market, to risk asset market, stocks, crypto included. Because crypto right now, major caps, it's indistinguishable from other risk assets, because it's the same bunch of investors. So what does this mean? Um, so the bottom line is, I think we're going to see a whole lot more volatility. While market going sideways, I do not expect we're making any new highs for BTC and ETH in the short term, because again, I just don't see acceleration of new funding coming into the market. Yes, there's always new funding coming into the market, both retail and institution, but really at this point we need acceleration for these major caps to go up. It's it's like if it's the same level of inflow, same quantity of steady inflow as we had before, it's not gonna help these major caps, because the market cap has grown, the size of crypto has grown. It needs more power to lift to be lifted up by the same percentage. Okay, while tightening is happening, while interest rate is raising, while uncertainty of macro environment is increasing, I just don't see where that acceleration is going to come from. So the best I'm hoping for in the short term is that we have sideways market for crypto as a whole, and then we have some volatility. We have increased volatility. But it's not going to do huge damage to the market until we hit that turning point when balance sheet turning from increasing to flat. When is that going to happen? I don't know. It may happen this year. In this quarter, I think we start to see deceleration of balance sheet expansion. It may happen this year. Keep in mind, last time, Bernanke said they were going to taper. They didn't do anything. They didn't really taper till a year later. Okay, this time I think they would do it faster, because you have higher inflation. That was actually a pretty serious threat, right? So I think they're going to start doing it quicker. So I expect sometime this year, maybe not in the first quarter, maybe in the second quarter, third quarter, I don't know, when this turning point may be happening. And that's when it's going to hurt risk assets in a major way, especially the bigger caps. So that is the short-term bear case. I'm sorry if it hurt your feelings, okay? It made you disappointed, but I'm just telling you, as straightforward as possible how I see this happening. I'm not saying I'm right. I hope I'm not right. I hope all the risk assets I hope all your bags go up forever. Okay? But that's not a reality. So another bear factor, I know there's another, sorry about that, is that if you look at what's happening in crypto, project fundamentals, when the beginning of this bull market started, so the 4-year cycle of Bitcoin aside, what actually kick-started everything else, including Ethereum, including other all layer ones and everything else, is the DeFi summer. All right, so or DeFi spring, summer, I don't know. In 2020, when the seeds that was planted from the previous cycle, the innovation in DeFi that was planted in previous cycle started to come into fruition. So we had these automatic market makers, we have these DeFi lending protocols. They started and stable coins protocols, they started doing a whole lot better and started doing a whole lot more volumes, right? So those are the major innovations that was underlying innovation that was driving this cycle of crypto adoption. And then we had NFTs, which was also actually an innovation from previous cycle, but it was this round it did a lot more. It became more mature, and it got picked up by more mainstream adopters. So what has happened since then? DeFi summer was like 2020, right? And you had NFT, which was like the first NFT boom, also late 2020, early 2021. You had these profile picture NFTs going berserk. Everybody's, making profile picture NFTs. What happened since then? There hasn't been seriously groundbreaking innovation since then, I would say. The innovations from the last cycle that came into fruition in this cycle, they are still, carrying the major load, a major weight of user adoption and user activity on chain to this day. And the newer projects, nowadays you see what's in DeFi. Every new chain, whenever a new chain launches with layer 1, layer 2, you have a DEX, decentralized exchanges, you have maybe a lending protocol, maybe you have a derivative protocol. But seriously, there is not a whole lot new things happening. It's just pretty much the existing playbooks being played out in new real estate, in new chains. That's the same thing for NFTs, right? A little bit new things happening in GameFi, in blockchain gaming or gaming that uses blockchain elements. So my point is, there has not been groundbreaking innovations in either DeFi or NFT in the past 6 months. So that's why, at the beginning of the year, I figured next wave of mainstream user adoption has to come from GameFi, or has to come from blockchain gaming, because that is the next frontier, because you're not seeing a whole lot groundbreaking innovation in DeFi and NFT, which is the main workhorse use cases on chain right now. Now, I know some of you thinking, how can you say that? Why don't you go look at protocol XYZ, Yeah, I know. There are new things happening. I'm not saying there's entirely dead, no innovation, okay? I'm just saying those are marginal improvements, including a lot of the DeFi projects that basically moving TradFi into DeFi. How is that innovative? So those are like marginal improvements. They're not really the major issues that blocking mainstream adoptions are still not being solved. The UX issues not being solved. Okay, it's pain in the ass to use blockchain. And the off-chain assets, for DeFi to grow next stage, you have to actually do serious, financial intermediation, meaning you have to lend people money for other use cases other than speculating in your DeFi apps and earn yields, right? So right now, if you look at what's the lending rate in the DeFi lending protocols, you have a much higher percentage deposits than lending. It's not really being used to full capacity. Why? Because there is not that many use cases for on-chain lending. So until we find a way for DeFi lending to be used in productive use cases, when people can take out a loan to buy a house, to start a business, to make major purchases in their life, that it's like where is the lending demand going to come from? Where is the mainstream adoption going to come from? So again, in the long term, please differentiate long term from short term. Okay, in the long term, I think all of that is going to happen, but I highly doubt it's going to happen in the next 6 months. So while at the same time, despite the fact that innovation is slowing down, okay, innovation is slowing down, And another thing is that we've got to bridge off-chain assets on-chain to use as collaterals. Otherwise, you cannot. How do you on what basis can people borrow money if I don't have a large chunk of crypto assets sitting in my wallet? If my most my net worth is in traditional assets, how am I going to use DeFi to borrow money? So there's that, multiple roadblocks for mainstream widespread adoption that need to be overcome, and that I do not see happen in short term. While at the same time, you see so much money flowing into crypto, right? Every other day, you see announcement of VC fund raised $1 billion and investing in crypto funds, and chain XYZ raised $1 billion to invest in ecosystem projects. So essentially, you have so much money chasing decelerating innovation in the short term. So what you see, it's what's the sure result is you're going to have valuations of existing protocols and new projects that are not serious innovations, but their valuations going up, right? So that's what we are seeing right now. And there's another reason which I'm getting into in a minute. So seriously, this is not. It doesn't bode well for a short-term bull case for how much higher this market is going to continue growing. Okay, so that's the bear case. That's the bear case. So, but I told you at the beginning this is a little bit complicated, right? So, I also have to tell you some bull case. Bull cases. What are the bull cases? Number one, as I already mentioned, the QE is heroin. The interest rate is coffee. The QE is heroin, right? So until the heroin is taken away, it's not going to be a huge impact on risk assets, I don't think. But from quantitative easing, accelerate asset purchases to deceleration of asset purchases, to completely stop of asset purchases, to shrinking of Fed balance sheet. That's a several turn. And several turns not going to happen overnight. So this still take a while. Again, I don't know. Don't ask me how long this is going to take. I don't know. But it's not overnight. Maybe a few months. Maybe like 2-3 quarters. That would be my baseline guess. It also depends on how the economy is doing, right? But like we talk about, the economy is not doing bad at all. The U.S. economy. So that's going to take a while, which means in the short term, you still got some level of breathing room for risk assets, including crypto. You're going to see higher volatility. Market goes up and down. You're not going to see probably not going to see new all-time highs or breaking of all-time highs. Okay, so you're probably not going to see breaking of all-time highs for the bigger caps because of all these. But it's not exactly a market crash either. So while that's going on, another bull case is that if you look at the Bitcoin dominance, actually Bitcoin and Ethereum dominance add together, it's about 60%. Okay, right now, which is kind of ridiculous because we are at the so-called late stage bull cycle, if you buy into the 4-year cycle of Bitcoin, right? But it's only the Bitcoin dominance plus Ethereum dominance, it's still 60%, 59% of the total crypto market cap right now. in early 2018, the height of the market boom, last cycle top, it dropped to like 55%. So right now we are even higher. Large cap dominance is even higher compared to the same point at previous Bitcoin cycle. How can this be? You have seen the boom of Solana, Avalanche, Terra. You have seen a boom of, FTM. You have seen Axie Infinity. Bazillion so-called quote unquote altcoins rising 1,000, 10,000% in the last year. How can we still have Bitcoin and Ethereum dominance so high? Well, the reason is, first of all, Ethereum hasn't been doing so good the last 6 months because network congestion, user adoption not growing, and same thing can be said about Bitcoin. While these newer chains are going much faster, but keep in mind those newer chains, they started very small. They started pretty much zero, okay? So it will take them a while to actually catch up to a meaningful market cap. While at the same time, you have a bunch of altcoins from last cycle, things like Litecoin, okay? Or Bitcoin Cash or whatever else. Those have been completely hammered in this cycle. They used to be in the top 10 market cap, okay? And some of them right now, they're still in top 10 market cap. I'm not going to name names, but you're smart. You know what those are. So, those things have not been growing. So while you have these smaller, really, really small new generation of quote unquote altcoins going, yes, very, very fast, but still very, very small. So on balance, it really doesn't take away too much from the large cap dominance. So what does this tell you? I think what this tells you is that what this tells me is that there is still room to go in the speculative cycles of non-major cap crypto tokens. Why? Because if you look at, from the flow of funds point of view, why do these smaller caps pump in late cycles? Because in the beginning of a cycle, at least in the Bitcoin cycle, which is still dominant, right? Because it's 40% of the market cap, still big. You have new money coming in, an acceleration of new money coming in to chase the gains of Bitcoin and Ethereum, okay? And these new money, they coming in yet, and then these major caps, large caps, they go up, and people are in profit. Once you're in profit in these large caps, what do? You look around, you're like, okay, I can go out a bit on the risk curve, and I can venture out to see what else I can invest in. So you go invest in something else. You go invest in Solana. You go invest in Terra. You go invest in Avalanche, Near. I don't know. But it doesn't take much for those to pump because keep in mind those are much smaller market cap. Okay, so that's why in late cycle you see this rotation. Basically, people take profit from these larger caps. At least partially, you're not completely clearing out your position from larger caps. But even if you spread out, even if some of the money in larger caps rotate into these smaller caps, it will cause them to pump a whole lot more in terms of percentage-wise because they are small. Okay, so that's why you see in later stage of the cycle, like in late 2017. Also in the last cycle, Ethereum was also counted as a altcoin at the time. Now it's part of the establishment, right? So you see money flowing into those newer tokens, and you see they go up a whole lot more. And then that's why in late stage of Bitcoin cycle, you see large cap dominance goes down dramatically, okay, because of this flow of funds flowing from rotation from large caps into smaller caps. Now, you see the same thing happening in this cycle, but again, it's just not happening a whole lot because we are still at 60% of Bitcoin plus Ethereum dominance compared to about 50%, 55% in January 2018. Despite the fact that we've had so many more actual real use cases on chain, you've had a actual genuine Web3 economy with DeFi, with NFT, with gaming happening on newer chains. They're not happening on Bitcoin for sure. Those are actually, productive use cases, and the market caps of those are supposed to go up, but still you are seeing this dominance, very strong dominance of major caps. So what does this tell you? What it tells me is there is more room for speculative money flows into smaller caps. So, and that's what you've been seeing, right? Over the past year, it was first Solana, and then it's Avalanche, Polygon, Luna, a bunch of other things, play to earn, a bunch of DeFi, V2 DeFi. And now you have the second tier layer ones. You have Near, you have FTM, you have Harmony start pumping whole lot in December, January. And this is still ongoing. So that is I would say sort of if you can call it a bull case. It's not really a bull case, it's just speculative flow of funds. So what it tells you is, as long as the market doesn't nuke, meaning if the Fed balance sheet situation does not have a major turning point in the short term, you should still continue seeing the rotation game going, where the funds flow from major caps to smaller caps, and the smaller caps pump more, until we see this Bitcoin and Ethereum dominance drop I would say for another, I think another 10 percentage point drop, 10 to 15 percentage point drop in BTC plus Ethereum dominance, given this stage of cycle, is totally justified. So that means right now we are at 59. It should be, at 45 to 50. That will be, I think that will be how low it can go. Given we have so much more on-chain economy, so much bigger use cases going on compared to last cycle. Last cycle, even without any real use cases, altcoins, bunch of garbages pumped so much more. So again, I'm not saying this is good or bad, or right or wrong. This is just matter of fact. Okay. So how are we doing on time? Well, we are doing badly on time. I'm running out of time, so I'm gonna go quickly next. So what does it mean for your strategy, right? So there of course you can play it different ways. Like I told you earlier in previous previous videos that long term, again, I'm bullish on crypto. I'm not gonna leave the market, and you going in and out of the market, sometimes it's not worth it, right? Because price can go up quickly. But at the same time, you have clearly seen macro conditions worsening in the near term. So you could, option number one, you could write it out. You could just hold whatever you're holding and just you know, don't just not take in any of this, right? So people actually did that. Some people, they did that. They hodled through the entire bear market, right? So you could do that. The challenge of doing that is obviously a psychological challenge. I think that's the number one challenge is psychological. You have to make sure you don't panic, maybe at the trough of bear market or at the market sell-off, that you don't panic and sell everything. That would be the worst decision that you can make, right? So if you decide to hodl, you gotta take care of that psychological challenge, and that is not a small challenge. I would say it would not feel good if your holdings drop 80%. Next morning you wake up and see your holdings, dropped to a very much smaller percentage. It's not a good feeling. Okay, that's not something that most people would be willingly subject themselves to. So that's I would say more of a psychological risk rather than financial risk. But obviously, if there is a psychological risk, you're more at risk of making wrong financial decisions, right? So that's the option. The option number one, just you huddle through. You disregard any of this rotation game. You just pick the ones that you have long-term conviction in and just stick it through. Right. So number two, you can ride the rotation wave. That's sort of what I'm doing. Is I have actually moved a lot of my originally. I had a lot of Solana and Avalanche. And quite a bit of Luna last year. And then last couple months, I basically moved them to tier 1. Either tier 1 layer 2s or other newer projects that I think have a more relatively more reasonable valuation and more solid fundamentals. That's all I can say is relatively, because the whole market is pretty frothy. Okay, so because I expect the rotation to be ongoing. Okay, so whether that's the right strategy, wrong strategy is I cannot tell you right now, because that's still, the story is developing. So far so good, but the story is developing. Who knows? So that's number two. You can rotate. You can play the game of large cap to small cap. Given the trend that we probably still see large cap dominance going on. That's there's something that you can consider. And by the way, I'm surprised I have to say this. None of this is financial advice. Okay, I don't take care of your money. You take care of your money yourself. Okay. And if I change my strategy, I have no obligation to tell you, because market conditions change quickly, and I may adjust my opinion, which I should. So I'm just laying out the options that I see, right? It's your own judgment call. And also you can also do a combination of both, all right? You can say, okay, I don't know. I don't like this choppy market. I don't like high volatility. It's hurting my well-being. It's creating extra stress, and I don't need extra stress. So I take a percentage out of the market. And so I take a percentage, I don't know, 30%, 50% to 60%. Depends on what you feel comfortable with. And I just, try to wait out the volatility later. But the risk of doing that is you may miss the upside, right? and since the crypto market is on the way up quickly. And also, once you start doing this, going in and out of the market, it introduces a lot more uncertainties in your decision making, right? Because HODL is easier decision because it's just one decision. Stick it through. If you start going in and out of market, it introduces a lot more variables in terms of decision making. You have to decide when to get out. What's the percentage you want to be out? And when to get back in. That's already 3 decisions right there. What is the possibility? What's the probability that you make all those 3 decisions correctly? So that is the risk to consider if you want to either play the rotation game or you want to take a percentage out of the market to wait out on the volatility, right? Because you don't know you don't know the timing of the Fed, how long this tightening cycle is going to last, when is the balance sheet turning point is going to happen, when it's going to stop happen. You don't know any of that, okay? So that's that. But those are options. There's no free lunch. There's a pros and cons to everything. and also another option, I wouldn't call this option, but it's the variation on the same option as the last one, is to say, okay, maybe I change my strategy. I take some of the money out of like an active holding into some like a passive holding that more like annuity, investments. I would call those the real estate equivalent of crypto investment. What are those? Those are things like, staking nodes or like, hosting services that gives you like a staking reward for processing transactions or processing volumes of like a file storage and so on and so forth. The ones I'm doing, there are a lot of these out there, okay? I'm just telling you the ones I know and the ones I'm doing. I'm doing Gala nodes. Gala is like a gaming company, right? They have like decentralized nodes for processing their, transaction volumes and file storage. So I'm running Gala nodes. I'm running Pocket Network nodes. Pocket Network is like a decentralized Infura, and I tweeted about it a couple times on Twitter. I don't know if you saw it, but you can do some research on them. But basically, you can run nodes to help them, do like a relays in multiple chains. And then Helium is another one you can do. You can run Helium nodes. Oh, actually, they're not called nodes. What are they called? I don't remember. Helium, that thing you get a like this box of hardware. It's a node for like a decentralized 4G coverage for internet. So you can get some rewards from that. I call them like a crypto equivalent of real estate because these are like a kind of a sort of a long-term investment that you get periodically. You get some rewards, just like you rent out your house and you get rental income, right? And at some point you can sell your house, and in this case you can sell your nodes to someone else. So but those kind of like you don't actively manage them. It's easier than real estate, and I don't go actively buy and sell my nodes. I just let them sit there and they have some periodical rewards. So that would be a way to diversify your holdings. I wouldn't say they necessarily reduce your volatility per se, because if crypto market tanks, the value of your reward tokens, they're all going to tank in any case. But it's just a more passive income flow, more periodical passive steady income flow compared to you just hodl some tokens and hope hope they will go up, right? So those are different options, or you can do a combination of all those options. I don't know. So, but in any case, those are some of my thoughts on where the market is right now, and some of the options that I see in terms of managing portfolios. Again, not investment advice, and I do not have clairvoyance. I have a human brain, just like you do. I may have more information or perspectives because of my professional training, but that's about it. Okay. In any case, be careful out there. Okay. And I hope your tokens all go up forever and they never drop. So, and also, if you are listening to this, actually, it's the other way around. So I mentioned this before. This is a YouTube channel. It started as a YouTube channel, but now I automatically convert them to podcasts using Soundwise, and you can find this on all the podcasting apps that you listen podcasts on. Just search for Tasha Labs. And you will find those, and you can listen to these on the go. Okay? That's all. Bye.